test, mic test. Okay, very good afternoon to each one of you. I hope you all can hear me. First of all, thank you so much for being here. I think it's been a long while, a couple of years since we ever have a physical event like this. So it's great to see so many people coming for this talk. Now, I really only have got 20 minutes, so I want to get on with it. But just before I start my talk, I just want to say that because I only have 20 minutes, there are a lot of things that I don't have time to say, and I can only offer something that is at a very high level, conceptual. So please do not take this as advice, because all of us, our circumstances are different. Some of us, we are accumulators, some of us, we are retiring. And so, you cannot take a 20 minutes talk like that and just apply it to your situation. Yeah, but I hope in these 20 minutes, it gives you some idea on how you can approach your investing. In money management, it is really a balance between investing and cash flow management. I'll say that again. In money management, it is really a balance between investing and cash flow management. If we don't have cash flow, it is very difficult to invest for the long term. But if we don't invest today, we don't have cash flow in the future. Right? So it's really a balance. And as I was preparing for this, there were so many things for me that I wanted to say, but I've only got 20 minutes, so I'm just going to restrict to a lot more on the investing side. Now, it's interesting that the title or the theme for this entire expo is "This year it's different." So when I saw this, I tried to be a bit naughty and I say, "This time is different." Really? Is this time different? So what I did was I went back to history. I hope you can see some of the events that has occurred. Of course, I can't put down all the events, but some of the events that has occurred in history. I just want to show it to all of us. Okay, I can't see it very well, so I'm just going to go to the side here. Okay, so if you see 1974, I was only 4 years old in 1974, right? There were a few key events that happened in 1974. Firstly, the collapse of the Bretton Woods system. In simple terms, this was the time whereby the US delinked themselves from the gold standard. It's no longer pegged to gold. And then there was the devaluation of the US dollar. And if you remember, for some of us who are more senior, the oil crisis. Right? There was an Arab oil embargo led by Saudi Arabia against those countries whom were supportive of Israel. And as a result of that, oil prices went up. And we all know what happens when oil prices goes up. When oil prices goes up, things become more expensive. Inflation happens, market crash. And that led to the crash of 1974. Right, and of course, I realize there's a TV here, so I can stand here. And then of course in 1980, because of all the policies that were put in place by the US decades ago, like for example, the pro-employment production, as well as the maximizing of the purchasing power policies in the 60s put together by the US. Meaning to say, after the Great Depression, the US started putting policies to support maximum employment, to support spending. And you know what happens when central banks start to support spending? Inflation starts to rise. And again, because of the collapse of the Bretton Woods, the oil crisis, that led to inflation peaking in 1980. Right? And you see inflation was 13.5. We are not even there today. But that was what happened in 1980. And that, of course, led to the market crash as well. Then, of course, in 1990, many of us will remember, because Iraq wanted to acquire the reserves, the oil reserves in Kuwait, and also because they wanted to cancel the debt that they owe, or the money that they owe to Kuwait, they invaded Kuwait. And that started the US-Iraq War #1. Okay, and for a short while, the market crashed. Okay, and of course, a few months later, when US invaded Kuwait, very quickly, just after a few hours, the investors realized who is going to win the war, and the market recovered again. And 2003 was the second Iraq war. That's now the President George Bush Jr. who led this war. Now, so let's take a look at what happened in 2003. Now, because even though the US won the first war, they let Saddam Hussein continue to reign in Iraq. But they wanted to undermine, or US wanted to undermine Saddam Hussein's power, and so they waged a second war. And of course, the US claimed that, Saddam has got weapons of mass destruction. Many years later, they discovered they actually don't have. And of course, there were a lot of theory why US went in. I'm not here to talk about that. But that was what happened in 2003. And again, that led to the Iraq war. And when people heard of US wanting to go into Iraq to wage a war, the market fell. But the minute the war started, they remembered the first war. They knew who was going to win. Then the market recovered again. And now, of course, nearer to us today, many of us will never forget the 2008 global financial, the GFC, the global financial crisis. Falling US prices, a lot of subprime borrowers who were not supposed to borrow money, the bank lend them anyway. And then when the market or when the houses fell, the price of the house fell, right? They were in trouble. They couldn't top up the difference of the loan. They couldn't repay the loan. Many of them defaulted. And there were a lot of structures built around all these subprime mortgages. And as a result, it caused the 2008 GFC. And I'm sure many of us remembered. Well, the GFC, the start of the GFC really was in September of 2008. Of course, all the subprime borrowing, all that happened like in 2007. But in September 2008, the market started crashing, and you remember Lehman Brothers collapse, Bear Stearns and all that. The markets continued to fall until March of 2009, 6 months later, right? And then in April of 2009, the market recovered and continued to recover until December 2021, right? And then of course, last year, the market fell again. And so we have 2002, which is really last year. If you have been investors last year, realize that last year is a bad year. I mean, if you invest in the markets, you would have lost money everywhere, except if you had invested in STI, maybe STI would have done well. STI was up 4% last year, and commodities did well. Other than that, everything else failed. So, 2002, what was the problem? Excess liquidity because of the pandemic. Again, the central bank in US printed money. Okay, and because of excess liquidity, a lot of money in the system, well, the stock, it caused inflation. Yeah. So inflation happened because of that, but inflation also happened because of supply chain disruption due to COVID-19. Primarily China, the supply chain was disrupted. So supply came down. There were a lot of demand because of excess liquidity, inflation, and then plus it got worsened because of the Russia-Ukraine war. I never knew that Ukraine was the largest exporter to Europe in terms of corn, sunflower seeds and all that. And they're the second biggest exporter of oil and the biggest exporter of natural gas. So when there was a war in Ukraine, again, lack of supply. Inflation happened. So last year, markets fell generally. If you invested in the US market, the S&P fell close to about 20%. Nasdaq was even worse. Right, so this were all the events that happened in history. So is this time different? Is 2022 different? Well, I'll say this. The events that led to the market collapsing can be different. They have to be different because the world is a very uncertain place. But the motivation behind these events happening are always the same. Countries quarreling with each other, a war happening, central bank printing money, excess liquidity that led to inflation. They are almost always the same. But the one thing that is always the same is that after a collapse, the market always recovers. And this history goes back to not just 100 years. In fact, if you read Jeremy Siegel's book, Stocks for the Long Run, this history goes back all the way to more than 100 years, that it always goes up. So I'm just going to show you this chart, right? If you have read some of the articles that I've written, you have seen this chart many times. So if you look at this, this is the MSCI World Index. The MSCI World Index consists of 23 countries of the developed market. Singapore is in it, by the way. Yeah? And if you look at the MSCI World Index from 1970 to 2020, the stock market has gone through different events, geopolitical events, natural disasters, wars, inflation, market collapse, a pandemic, 2022. But the market always goes up. 5 minutes? It's 10 minutes here. I cannot finish in 5 minutes. There is no way I can finish in 5 minutes because I'm following the clock here. I'll do my best. Okay, so now, a disciplined investor looks beyond the concern of today to the long-term growth of potential markets. So, well, if you are disciplined investors, you look beyond the short-term volatilities and you take heart that the market will recover. Now, I can't do it in 5 minutes because there is an article that I want to show all of you. Not many of us have read this article before, and I'm going to show you an example. It's important because in the midst of volatility like this, people, you will always hear stories from managers, fund managers, media. And this is what the media said in 1979. This is a legendary article from the Business Week. It's part of Bloomberg, by the way, now. Okay, so in the Business Week, I hope you can read it. Okay, it says the death of equities. They predicted that the stock market is going to die. Okay, and this is the synopsis. The masses long ago switched from stocks to investments having higher yield and more protection for inflation. Now, the pension funds, the market last hope, have won permission. Okay, I'm just going to summarize and say this. The pension fund, the government gave permission for the pension fund in the US to invest out of stocks into other things such as diamonds. Okay, that was what it was said here in 1979. And it says that Wall Street, now they're not interested in stocks anymore. They are more interested in options, futures, and buying into insurance. So let's look at some of the excerpts very quickly, okay? So if you look at this, you just look at what I've highlighted, okay? Basically, it's saying here that you can take a picture and read it slowly. But it says here in the article that they have given permission for pension fund to go into gold and diamond. I mean, gold I can understand, but diamonds as an investment. In 1979, that was what they said it's going to happen. And then in the article, they said that only the old people were interested in the stock market. The young people are not interested because passé, stocks no longer in favor. So if you look at what I've highlighted, okay, it says here, we are running the risk of immobilizing a substantial portion of the world's wealth in someone's stamp collection. Basically, it's saying, not interested anymore. You can keep it. Stocks, it's like a stamp collection. It's old thing. Okay, now, some more excerpts. Okay, it says here, just look at the one that I highlighted. You can take a picture and read the rest later. Today, the situation has reversed, with bond yielding up to 11% and stock averaging a return of less than 3%. So what Business Week is saying is that bonds is better, stocks is lousy. That's very short term, because if you look at the long term, the equities have always beaten bonds. Now, what else? Further, this death of equity can no longer be seen as something of a stock market rally. It says here that no. Don't always think that, when the stock market crash, it will come back. No more. Okay, that's what Business Week say. No more, right? Now, the last part, only the elderly, the old people, who have not understood the changes in the nation's financial market or who are unable to adjust to them are sticking with stocks. That was like before last year. Stocks, lousy. Better buy crypto. And then the older people say, I don't understand crypto. I better stick to what I understand. That was exactly what happened in 1979. They're saying the old fogies, they don't understand. So they are still investing in the old thing like stocks. Only the elderly remains. Some more, okay, the range of investment opportunity is so much wider now in the 1950s. Why stick to stocks? This was 1979. You are probably hearing the same thing today. There are a lot more options. Why just stick to something so boring? Last part, okay? Wall Street has learned that there are more profitable things besides stocks to sell. Among them, options, futures, and real estate. This is scary because, well, the Wall Streets are just selling what is profitable for them. And it says there, well, it may be reversible someday, stocks, but not anytime soon. Okay, then they interviewed this guy, okay, a professor from this South Methodist University Business School. We have entered a new financial age. The old rules no longer apply. Okay, people no longer think of stock as an inflation hedge, and based on experience, that's a reasonable conclusion for them to have reached. 1979 Business Week. We are all thinking shorter term than our father and grandfather did. we are all thinking shorter term. The second bullet point. Have you been to an American stockholder meeting? They're all old fogies. The stock market is just not where the action is right now. But take a look at what happened after this article was written. The article was written August 13, 1979. But the market went up thereafter. Most of the time, the media is wrong. So, in the midst of volatility, as you hear many of these things, I know the time is up, but I'm just going to follow this clock. 5 minutes. Okay? Most of the time, you will hear of all these things. But be careful what you hear. Look for evidence. That is more important. So why do stock market goes up in the long run? Why? Because earnings. The primary factor that drives the long-term returns of stock market is earnings. What drives earnings or profitability? Demand. What drives demand? Human needs and wants. As long as we human needs have want, last year can be a bad year. If your phone is spoiled, you buy a phone. If you want to drink a coffee, you buy a coffee. As long as humans are still around and the world needs to trade each other to fulfill human needs and wants, well, the stock market will go up in the long run. It's as simple as that. But in the short run, many things can happen. Like now, everybody is quarreling with China. But this is not the first time the world is quarreling with China. They will quarrel all the time, right? And there will be wars all the time. In the short term, we just don't know exactly what will happen and when it will happen. And even if you know when it will happen, there is no way you will be able to guess how the market will react next. They said that if Donald Trump wins the election many years ago, the stock market will crash. If Hillary wins, the stock market will go up. Well, Trump won. Even if you got it, that Trump won and you got a market, the market reacted differently because the stock market went up. It's very, very difficult to guess. So you either choose to invest for the long term, or you must be able to guess exactly what is going to happen for the short term. And like many professional managers, and I say this with a bit of fear and trembling because I'm in the midst of many professional managers, they try to guess the market in the short term. I'm going to show you, this is from the Financial Times, 11 October 2020. It says here, most active managers cannot beat the market. 2020, November, active managers struggle to prove their worth in a turbulent year. January 2022, most of these active managers, stock pickers, they failed. And then I saw this September last year, and I said, wow, the active managers come back, finally. But take a look at it, you're not going to be able to read this, so I'm going to show you this, okay? So I expanded it, and that was what the article said in Financial Times. It has so far been a slightly less terrible year. They come back because it was less terrible for them. Not that they have done well. Okay, a mere 51% of the large cap funds have underperformed the S&P 500, and they come back because previous year was worse. 85% failed, so today 51%, so better. You get what I'm trying to say? It's very difficult to try to guess the market. So you're going to hear many market outlooks for the rest of the year. What's going to happen to inflation, interest rate, will the war go on and all that. Now, you are not going to be able to decide whether the future forecast is going to be right. So what do you do when you are unsure? Let me just give this advice. When you are in the dark, look at what has already been revealed in the light. Ken? When we are in the dark, look at what that has already been revealed in the light. What has been revealed in the light? These are the evidence. This is from 1970. You can see in the long run, the stock market always gives you that positive return. But I have to say this, I don't have time to say this, but I have to say this. Positive doesn't mean enough. Sometimes, even if it gives you positive, because of the period you invest in, you might not get enough returns. I don't have time to expand this. Yeah? But I just have to insert this in. But I hope you draw courage and encouragement. I mean, you can ignore all this noise and all these predictions. Anyway, most of the time, the predictions are wrong. So if you invest in the long term, you are going to get enough return. Today, if I'm the weatherman and I tell you that it may rain today, what do? Well, I'll say go to work, but bring an umbrella. You are not going to listen to the weather forecast, man, and just because it says it's going to rain, you're going to stay at home and you're going to call in and tell the boss, I'm not going in. Why? Because the weatherman says it's going to rain today. Your boss will tell you, don't come in tomorrow. The weatherman may be wrong, but we listen to weather forecasts because we just want to prepare ourselves. We still go to work if we need to go to work, right? But we bring a good umbrella. What is a good umbrella? And this is my last slide. Okay, what is a good umbrella? This is the personal wealth equation that I've developed some time back. Very simple. All of us earn an income. After we take away our savings, our fixed expenses, we are left to spend on things that are not necessary, variable expenses. Our savings, if we invest it compounded by the returns over a number of years, it will help us reach our future goal. The left side is the short-term financial planning. The right side is the investment. If you are invested for the long term, stay invested and keep investing for the long term. But the only way you can do that is that you have to keep your left side very strong. What do I mean? It may not be the best time to change your job. Maintain your emergency fund. Optimize it. You can put it in FDs, SSB, T-bills if you want. This is a good time to re-budget. Is there a possibility to lower your expenses? Be prepared for higher expenses in mortgage repayments. Consider repaying some of your loans if possible. Review your insurance portfolios. A lot of Singaporeans spend a lot of money buying unnecessary and unsuitable insurance policies. At the end of the day, premiums very high but not adequately covered. So review your insurance portfolio, be adequately and comprehensively covered. Get rid of unnecessary insurance to lower your costs. Reduce premium payment if possible. And if we do that, that is the left side. That is the good umbrella. Okay? Now, I just want to end with this. And I'll disappear because you're not very happy already. You will hear a lot of predictions. You will hear. History and evidence have shown most of the time it is wrong. But does that mean that these predictions are of no use? They are useful. It's just that we use it wrongly. The predictions are not meant for us to change our investment strategy. It's not meant for that. Predictions are always short-term. Investment strategy is long-term. We shouldn't use short-term information to help us make long-term decisions. That's wrong. We use short-term information to help us make short-term decisions. What are the short-term decisions? Our daily financial planning. If I know that the next 12 months, 24 months is going to be tough, I make sure that I tighten my belt. I make sure that I save. I live a simple life. I must make sure I can go through the next 12 months to 24 months. Because if I can survive the next 12, 24 months, I'm not worried about my long-term investments. Am I okay with that? With that, thank you very much. I hope you have a good day today. Thank you.